Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Rima and Mangalam is with us today. Guys, good morning.
Hi, good morning. We're also coming to you on the back of 3 days of gains for our market. And the clock is ticking because Trump's deadline for opening up the Strait of Hormuz is today, 8 p.m. Eastern Time. That's 5:30 p.m. India time. So 1 day to go.
1 day to go. Let's see what happens off that deadline, because the last time there was a deadline, just before that deadline, there was an extension or maybe some sort of comment coming in from Trump. But incrementally, what I see so far with the price action and what the action is happening around is that the price action impact is a lot more limited this time around than what it was earlier. So maybe are we trying to price in that sort of volatility and go with that?
Let me remember that Sunny Deol in the courtroom.
Tariq pe Tariq.
Tariq pe Tariq.
Why did you do that?
Anyway, I think that's enough dramatic theatrics for the morning.
I think beyond Tariq pe Tariq, the only thing which is left is now a 2.5 kilo ka haath.
Anyway, I think that's been used, right, multiple times in social posts and this and that. But I think you're absolutely right in terms of the fact that markets, and we were talking about this yesterday as well, markets are not so much going to be swung by what President Trump is saying now, but basically by what actually is happening. It's not as if there's a big disconnect between what is happening and what he's saying. There is still, U.S. and Israel are still attacking Iran. There are reports of large petrochemical complexes in the Gulf region which have been attacked and which have been disrupted. So it's not as if, the talk is all aggressive and there's peace on the ground. Not yet. I think markets will watch what actually happens rather than what is said. So let's just take it from the top. So U.S. equities rallied on hopes of a ceasefire. Pretty much a similar situation like what we had yesterday. S&P was up 0.45, NASDAQ was up 0.54. Oil prices $110 odd a barrel on Brent. And by the way, this was pretty slow. Last night was pretty slow. It's the slowest U.S. equity volume session of the year 2026 so far. But the next stat actually is more interesting, which is that the S&P saw the tightest range, which is the smallest intraday range for the S&P 500 since the war began, since the 27th, 28th of February. So, and this, by the way, despite President Trump speaking twice during the time the U.S. markets were trading live twice, and it did not move the markets too much. Maybe it was a mix of low volumes and people still sort of holiday mode, not everybody being back at their desks, etc. But I think this is a point which shows that maybe the markets are also now, unless there is something dramatically different or facts on the ground change, more of the same will have lesser and lesser of an impact in terms of markets out there. So in terms of the actual numbers, average intraday range of the S&P has been about 1.4%. Last night was 0.6 odd percent or so. So it's the smallest range despite Trump speaking live twice during the course of those 7-8 hours. Now, this is what he said, right, in those 2 live appearances. He said the entire country can be taken out in one night, and that night can be, tomorrow night. So again, this is not something new. It's different words to say the same thing, which is that, I'll bring, lots of destruction if my demands are not met. And he's, of course, set a deadline of Tuesday, which is 8 p.m. ET, which is tomorrow morning for us, by the way. This is early tomorrow morning. As a deadline for Iran to accept the ceasefire and open the Strait of Hormuz, etc., etc. He also said that we have to have a deal that's acceptable to me, and part of that deal is going to be to want free traffic of oil and everything through the Strait. So again, not very much new or incrementally new in that sense. Have we heard anything from Iranian side? Not anything which suggests that they are backing down at all. It continues. I don't think we've heard anything officially in the last 12 hours from the Parliament Speaker of Iran or others the Foreign Minister, etc., have been outspoken in response to, the war. but there's no sign that they're backing down either. I just sort of tie in. So basically, we are in a zone where the market wants to believe that even though the rhetoric continues to escalate, we are perhaps looking at some sort of a climb down. Both sides have taken hits. The US has taken hits. Iran naturally has, because that's the country which has essentially been attacked. So, and of course, I mean, the other side, Israel, although not very much news gets out of Israel in terms of the situation there on the ground, but admittedly, they've taken a fair bit of losses. So the market wants to believe that despite the rhetoric, which is, at a certain level, everybody is trying to find off-ramps and graceful exits without really losing face. So that's the position we are in. The supports on the Nifty are twofold. 22,800 is the first support. 22,540 is the next support. And the resistance for the market, the first resistance is 23,040. So these are very, very the nearest to where we left off yesterday. GIFT Nifty will tell you where we are this morning. It's 150 odd points lower in terms of a start. And the open is one thing, but as we've seen last Thursday, as we've seen yesterday, you get a lower start, and then there is interest at lower levels. There is buying which starts to come into and creep in at lower levels. At least we've seen that for the last two sessions or so. Mangalam is walked across to the wall with the F&O picture, the F&O stats. Mangalam, take it away.
Well, if you look at the cues and if you look at the news, along with the fact that the stock prices are moving in a certain direction, it tells you that maybe come April and the texture of the market may have changed. We've moved from a sell-on rally market to perhaps a buy-on dips market. Why do I say that? Because, we do have a bunch of triggers to track. One, obviously, is Trump's deadline for Iran to reopen the Strait of Hormuz. That is one. There is the Nifty weekly options expiry that plays today. The fourth quarter updates so far haven't been bad. In fact, some of them have been very good. And then we have the RBI monetary policy outcome tomorrow. Ahead of all of this, the GIFT Nifty is indicating a 180-point downtick. And the bulls would be happy with that, because the other part of the macro data, all of that is fairly steady. We have the US bond yield, which is hovering around that 4.35, no problem. Brent at around 111, no problems out there as well. Dollar index as well, not a massive move. So irrespective of what the GIFT Nifty is indicating, the US macros are all fairly steady. And the Nifty over the last three trading sessions as well has closed higher. So if you look at it, April 1st, it was 22,700, a little over 22,700 on April 2nd, and yesterday, a little under 23,000. So 3 days of positive gains. And over the last couple of trading sessions, both the lows and the highs were higher than the previous trading session. So that's a positive. Alongside that, while the FI is a selling in cash market, and that continues, unabated, over 8,100 crores sold yesterday, they have lessened their selling in index futures, and they actually turned buyers in stock futures. So index futures, yesterday the selling was just 45 crores, and stock futures, they bought about 900 crores. And as a result of which, over the last three trading sessions, mind you, they're still net short. It's recovered from 16% to 17% to about 18%. And ahead of expiry today, they've written nearly 6 times the number of puts as calls, which tells you that support is a lot stronger than resistance on the upside. So that's a positive. If you look at the active options, 22,800 put has a premium of 100 rupees, 22,700 put has a premium of 100 rupees. So between 22,600 and 22,700, there is strong support which is expected. And on the way up, the call writers are active only at 23,200, which tells you that maybe the 20-day moving average comes back into picture. For the last month or so, the 20-day moving average seemed unattainable. And now for the first time, after the Nifty having crossed the 5 and the 10-day moving average, the 20-day moving average seems fairly attainable. And similar is the case with the Nifty Bank as well. A 1,000-point rally, and the Nifty Bank too conquers its 20-day moving average. The stocks that I'm watching out for, Kalyan Jewellers did well. Now they have come out with a 64% growth in the fourth quarter. Good update. Weak update from Jubilant Foodworks. So there'll be, divergent moves here. And amidst all of this, Titan has steadily been making record highs, and their fourth quarter update is awaited. My sense is that the street would bet on the long side for Titan ahead of their update.
Thank you very much for that, Mangalam, for laying out the F&O turf for us ahead of the Nifty weekly expiry today. Let's get in some more comments. US President Donald Trump has reiterated his threat to Iran, saying that the country could be taken out in one night, which might be tomorrow night. He also says that they need to have a deal that is acceptable to him. Listen in.
Late Thursday night, an American F-15 fighter jet went down deep inside enemy territory in Iran while participating in Operation Epic Fury, where we're doing unbelievably well, well at a level that nobody's ever seen before. The entire country can be taken out in one night, and that night might be tomorrow night. We have to have a deal that's acceptable to me. And part of that deal is going to be we want free traffic of oil and everything else.
The silver lining is, if you look at the ship tracking data, there has been an uptick in the number of ships that have passed through the Strait of Hormuz on Saturday, Sunday. I think Saturday was 10, Sunday was 11, according to some, marine tracking data. Yesterday, according to some Iranian sources, about 15 ships, passed through the Strait. It's controlled. Iran still holds the leverage, and it's nowhere close to what it was pre-conflict. But there has been some uptick compared to what it was, say, in the early part of March. Rupal Bhanshali, founder and CEO, CIO, portfolio manager at Global Equities at Double Duty Money Management, is now joining in. Rupal, great to have you. Thank you very much for joining in. This is Rima here. In February, your view was that India's valuations are still stretched, especially when you compare it to the earnings growth. Now, since then, we've seen a war-induced correction in the Indian markets. Are Indian equities a buy, according to you, at this juncture?
Rima, thank you for having me. I'm afraid the answer is still a no. You have to zoom out a bit. I mean, this Iran war is obviously, the news of the year, and that means a lot of inflation. And frankly, Asian economies, Asian markets, therefore, being generally speaking net oil importers, will actually suffer. So the correction you've seen is more a reflection of this reality rather than a correction in the valuation for the same amount of earnings. On the flip side, I think that people also need to prepare themselves for a period of extended subpar returns, because one of the things that the market has benefited enormously from in the last couple of decades is a lowering of interest rates. Generally, the gravitational pull was down, which underpinned P multiples. Now it's the opposite. Inflation is proving more sticky and frankly is rising. And with high rates, equities need to compete. And the way to do that is to lower the multiple. So I'm afraid the setup is not looking good for investors at large in equity markets, but in India in particular.
So we're nowhere close to the bottom, at least for the near term, medium term. And how would you define, categorize an extended period of subpar returns? Because it's already been over 1.5 years where markets have done absolutely nothing.
Well, markets don't entitle you to returns. They have to be earned. And I think that we've pulled forward returns for a significant period of time, which means that we need to average them down because long run returns tend not to be double digits. And that's kind of what we've experienced all over the world, frankly, not just in India. So my call is not just, to be bearish on Indian markets, but generally speaking, global markets. I think there's a reset moment. And it really means we have to reposition portfolios. Look, after all, in investing, our job is to make money for clients, but to also avoid risk. And I think the opportunity, therefore, is going to be more in dividend yielding stocks. In the total return that you get from stock markets, the composition of returns has predominantly been capital appreciation in the last couple of decades. I think going forward, dividends will start playing a bigger role. So it's about repositioning portfolios, not avoiding investing altogether.
Rupal, hi, morning. Prashant here. And you've sort of outlined that thesis quite in a detailed way, the last conversation that we had. So just one quick view on things like gold, etc. At a time like this. Hard assets, basically. Rupal?
I'm actually quite bullish on hard assets, not specifically gold. I think inflation means that anything to do with resources, right? Hard commodities, which are still in demand all over the world, whether it's agricultural commodities or industrial commodities. And frankly, I'm a contrarian, so I'm not going to play through the obvious way of owning an oil stock. I mean, those have already run up. I think the non-obvious way to play it is by owning Latin American stocks. That part of the world is still extremely undervalued, despite having held up quite well. If you look actually at the global markets, LATAM is one of the few parts of the world that has held up very well, and rightly so, because they are oil exporting nations, resource exporting nations. And as these things are very much in demand, they're going to benefit a lot, and the trickle-down effect is going to be felt throughout their economies. And so there are many LATAM stocks that I think are still very investable, and that's where I would look.
I think I should just say American stocks, not Latin American, right, Rupal? I think President Trump
Latin
may take
American.
offense.
Sorry, that's what I meant.
No, I'm
Latin
just
America.
joking. No, it's Latin America. I was just saying that you should say America,
America
not Latin
is-
America. America is all
That's-
America. That part of the world. Anyway, Mangalam, go on.
No, I just wanted to know what you've made of the fourth quarter updates that have come so far in India. Financials, the loan growths haven't been particularly bad. At the same time, the consumption data that has come by, not particularly bad. Jewelers are doing well as well. Is there a possibility that the earnings trajectory may keep our markets afloat even though the valuation multiples are high, or do you see a risk to that as well?
Look, earnings growth always matters. And I think sectorally, there is always opportunity in every market. I mean, like you mentioned, the jewelry sector is doing quite well. But I think I'm talking about the market at large is quite unattractive. And frankly, as global investors, money flows to where the returns are. And I think the risk-adjusted returns are just superior internationally. And frankly, I think Indians would do well to diversify their exposures. I think the world is teaching us a lesson that we need to be diversified. COVID taught us a lesson to be diversified in our supply chains. Obviously, the same is happening now with this Iran war. I think diversification in portfolios is critical. And frankly, there's a lot of opportunity outside the narrow shores of America as well as India. If you know how to look for it, there's a lot of investment opportunities to be found. Investing is about not paying up for an opportunity, but actually finding something that's undervalued. That's how you lower risk. And so again, my argument is not to not own equities, but to own them in the right place, at the right valuations.
So other than Latin America, which other market looks attractive to you, where the valuations are comfortable?
Actually, lots of markets all over the world. I would say everything from UK to Europe to Singapore, lots of attractive opportunities in all parts of these worlds. Of late, the obsession has been to go for tech in the US. Even Japan is very much in vogue. India has been in vogue for, a long time. I think those markets, I would argue, are much more crowded. And frankly, the valuations there are not attractive. But outside of those pockets, which are crowded, there's a lot of opportunity in almost all parts of the world.
Rupal, good chat. As always, thank you very much for joining us. It's a pleasure speaking with you here on CNBC-TV18.
Good to be here. Thanks, Prashant.
Thank you. Okay, I think we'll take a quick commercial break. We'll come back in just a bit, but just running you through what's coming up here later. 9 o'clock, Karan Thurani Vilara will be with us. We discussed the updates in the retail space. So quarter on quarter, there's a pickup in growth. And actually year-on-year numbers, but tracked quarter on quarter. 9:20, Manish Sonthalia of MK Investment Managers, the market master of the day. So 9:35, Blue Star Management joins us. Stocks, of course, done poorly recently. Last week was bad. I think was down yesterday as well. We'll also have Motilal Oswal's Gautam Dugar at 9:45 this morning to talk about his New India Strategy report towards the end of the program. Lada's in conversation with Suyash Chaudhary of Bandhan AMC and Abhishek Upadhyay of ICICI Security Speedy on what bond markets are watching out for. This is RBI week. The decision is tomorrow.
All right. So that's about what we lined up for you on the show today. We'll take a short break, but on the other side, a lot of stocks that we will discuss today, and most of them on account of the fourth quarter updates. Godrej Consumer, Graded Axis Grameen, Kalyan Jewelers, Titagarh Rail Systems, KEC International, HBL Engineering, Kernex Microsystems. They are stocks which are likely to be on our radar on the back of positive news flow. We have Jubilant Foodworks, a poor update coming in from there, and Gujarat Pipavav Port stocks on our radar likely to open in the red. A mixed view on Fino Payments Bank. We'll get to it in just a bit.
Welcome back. The GIFT Nifty is suggesting a mild pullback in the markets, 150, 200 points low, less than 150 points lower now. This comes on the back of 3 days of gains. The level to watch after the markets perhaps see a bit of a gap down will be yesterday's intraday low of 22,540 approximately. From that level, we had rallied close to about 400 points towards the end of the trading session. But let's drill it down to stocks. This is CNBC TV18's list of top stocks for the day. Mangalam, lots of updates on the consumer side.
A lot of updates coming in from the consumer side. Yesterday as well, we had a few, and today we have one coming in from Brokerage Consumer, where it's a decent update. Sequential improvement is what we've seen. India business will deliver double-digit underlying sales growth, which is a positive. High single-digit, underlying volume growth. The last quarter they did about 9%, so that's exactly what is likely to continue this time around too. But the company says that excluding soaps, which are seeing some weakness, volume growth continues in double digits across their portfolio, so which is a positive. EBITDA margins in India likely to sustain in their normative range of 24 to 28%, so that's a positive as well. International, there are signs of improvement in Indonesia, underlying volume growth seen at mid-single digit, and decent performance, surprisingly, coming in from their Middle East, USA and Africa portfolio. And on that basis, they expect consolidated revenue growth of double digit with EBITDA largely in line. So going with green on Brokerage Consumer. Can't say the same for Jubilant Foodworks because one, the stock had been doing well over the last few trading sessions. Secondly, the street was penciling better performance than what the company has reported. Standalone growth of just 6%. Consolidated, yes, because Turkey has done well for them. But, most of the valuations coming from the India business, where Domino's India like-for-like growth has just been 0.2%. Turkey, obviously, on a favorable base, has grown 9%. But if you look at the trend of the like-for-like growth in India, over the last 4 quarters, you've seen a declining trend. And this one is the lowest that we've seen in the last 8 quarters or so. So 12.1, 11.6, 9.1, 5, and now 0.2. And which is why I expect some sort of muted performance on the stock in today's trading session. They've added 59 new Domino's stores, but at the same time, same-store sales growth needs to pick up.
All right, that chart is quite telling, that like-to-like sales growth. But the base was also high, right? In Q4 of last year, it was 12-13%.
Yeah, so on the high base itself, the company is, charted itself on a path of 10% revenue growth coming in from new store addition and 4 to 5% coming in from, like-for-like growth. So that hasn't happened.
All right, perhaps the LPG disruption is hurting Domino's India. But let's talk about...
That will be more of the first quarter phenomenon than, because this was just towards the end of March, right? So I guess first quarter will also be weak because the LPG disruption, and seasonally it's a strong quarter because of the IPL and all of that. So if you are reporting weak performance in a seasonally strong quarter, then that calls for a further downtick.
All right, interesting reaction. We'll wait by to see on Jubilant Foodworks, but let's talk about Credit Access and Fino Payments Bank. Ria joins in with more.
Well, good morning. Let's start off with Credit Access first. A positive business update here for the March quarter. Now, if you look at the gross loan portfolio, that has come in at roughly 29,590 crores, which is a growth of roughly 14% on a year-on-year basis and 11% growth sequentially as well. Even the disbursements have grown by roughly 28% compared to the previous year to around 8,300 crore odd. And the borrower additions have also gone up by around 27% compared to the previous year. And they've also seen a 57% uptick sequentially as well. Even the branch network has seen a growth of around 8% compared to the previous year for this. So overall, they have reported growth in the gross loan portfolio along with a sharp increase in disbursements as well as borrower additions. And they've also seen sequential improvement in asset quality, which has been reflected in lower PAR levels, which indicates normalization across operating geographies for them. But moving on to Fino Payments Bank, slightly negative update here. The deposits have come in at roughly 2,950 crores for them, and the loan referral disbursements have gone up by 96% sequentially to 600 crores this time around. The transaction business has declined by 30% sequentially, and even the digital payments business has seen a decline of around 25% compared to the previous quarter. Now, they have reported growth in the deposits and a sharp increase in loan referral disbursements, but this indicates traction in the credit-linked businesses, but the transaction and the digital payment businesses have declined sequentially, which suggests near-term pressure in the core fee-based businesses despite the recovery trends that we've seen in March.
All right, Ria, thanks a lot for that. But great performance coming in from Kalyan Jewellers. In fact, the one sector in the consumer space which has been doing extremely well for the last many quarters is the jewelry space. We saw Senco report its update as well, and Kalyan Jewellers, just hold your breath for this one, guys. 64% revenue growth year on year. India business growing 65%. The same store sales growth at 45%. Obviously, a large part of this is on account of the higher gold prices. But, as gold prices come down, the volume increases. So that gives them a natural hedge. international operations, which account for about 11% of their sales, were impacted by footfalls in the Middle East. There too, there was a growth of 45%. And Candere, which is basically the affordable, adornment jewelry, carat lane equivalent for Kalyan, that's on a low base, recorded revenue growth of over 360% as well. Add to all of this, the first quarter, they say, is good because the early trends that they have for Akshaya Tritiya and the wedding purchases are showing an up move. The stock obviously did well in yesterday's trading session, but it's still way off its 52-week high, so expect some green on Kalyan and perhaps a rub-off on Titan as well.
30% off from the 52-week high for Kalyan Jewelers. All right.
Absolutely. And, all these stocks, by the way, Thangamayil went up yesterday. Kalyan was up. Titan was the top gainers on the Nifty. So that entire jewelry pack looking pretty good. More on this one as we come up with market open a bit from now. But more stocks with news flow. Winnie is here with that detail. Winnie, good morning.
Hi, good morning. First up, we'll watch out for Gujarat Pipavav. Q4 FY26 update that's come in. Container cargo volume handled is down actually 4% at around 1.65 lakh 20-foot equivalent units versus 1.72 lakh in terms of TEUs. Dry bulk, that also has seen a decline of around 2%. Liquid cargo volumes also have remained largely flattish, a slight bit of a negative bias there as well. So 0.38 metric tons versus 0.40 metric tons last year. So overall, we're seeing a bit of a decline. That's why we're expecting red here. Titagarh Rail, we could see some positive sign here. The company's naval arm has gotten a nod for a brownfield capacity, and this is under one of the shipbuilding schemes. It's a 129 crore capital assistance that they will get in here, while the total cost of the project is going to be of around 610 crores rupees. And this is for the Falta project, which they've been focusing on as well. So shipping side, the infrastructure for shipbuilding side, the company has just started it recently, so more focus now comes in on this front. Lastly, we have Indian Railways that has actually approved projects of around 1,364 crores. This is mainly for the Kavach project. So safety, signaling, communication infrastructure across, railway networks. They've spoken about it as well. So Southern Railway, Northern Railway, they'll be focusing on all of this. There's going to be some optical fiber usage that they're talking about. They're talking about other systems as well, which will come into place and will be installed. So because of that, we have a whole host of companies that will be in focus. Kernax Micro Systems is another one, which is important and depends highly on these coverage orders. So very big positive for them. HPL Engineering, they also have a decent share in terms of coverage orders that come in for them. So positive there. KEC International, CG Power, among some of the other names.
Actually, there's so many other stocks also that we'll be tracking today. You can see that on the ticker there. You've got Shyam Metallics, where the March stainless steel sales numbers went up 58%. For PC Jewelers, the Q4 revenue growth was 32%. For Bharat Forge, the March Class A truck orders up 137% on a year-on-year basis. It's going to be an action-packed day in terms of individual stocks. Here's a quick recap then of the top stocks. Stocks with positive news flow are Godrej Consumer, Credit Access Grameen, Kalyan Jewelers, Titagarh Rail, KEC International, HBL Engineering, Kernax Microsystems. Stocks with negative news flow are Jubilant Foodworks, Gujarat Pipavav Port, and a mixed view coming through on Fino Payments Bank. But let's talk about commodities, currency, and all the action there. Manisha joins in as always. Manisha.
Thank you so much for that. I'll start with the crude oil prices, where we are holding 111 for Brent and 115 for the U.S. crude oil prices. Well, the U.S. crude is landlocked, more secure, and we're looking at a premium building up onto that one as well. Of course, both the crude varieties are trading in a backwardation right now, where the current month is more expensive than the future months right now. But clearly, it is about the U.S. deadline for Iran by Tuesday, 8 p.m., and then a 45-day ceasefire proposal being talked at the same time as well. And that's what's creating a lot of uncertainty into the markets. Having said that, there also is a report from IEA which says that there is 12 million barrels per day of a regional shut-in that we are looking at from West Asia, and there is a damage to about 40 energy facilities, and that premium will continue to be into the prices. Well, most banks and brokerages really are talking about 85 of a support on the lower side and 125 of a high for the month of April. That is the range for crude prices that seems to be emerging in right now. Having said that, it really is steady moves really coming in for the metal prices, not decline anymore. So whether it's about gold and silver, copper, aluminum, which is up nearly 8% on a week-on-week basis, most of these metals seem to be holding strong as well because of this uncertainty.
Right, Manisha. Thanks a lot for that. That's an update coming in from the commodities arena. Take a short break, come back on the other side. Mayuresh Joshi of Market Smith India joins in for some fundamental stock talk. Welcome back. This is Bazaar Morning Call. The Gift Nifty, when we started the show, indicated that there would be a 180-point downtick that has now been coming off to about 150 points. And as we speak, there is a forecast for the southwest monsoon, which has been released by SkyMet as well. We'll get to it in just a bit, because that will be very important to track how the consumption pans out in the second half of this year, especially
The headline seems to be the monsoon is seen below normal at 94% of long period average. So maybe we can speak to SkyMet and we should dial them up straight away. And they're saying that El Nino is expected, this weather system is expected to strengthen, impacting monsoon in the second half. But they're saying 94% long period average. There is, of course, that error rate, I think plus minus 2% or...
I suspect it's 5%.
5 would be too.
So it is a...
Yeah.
Because it's also their first forecast, right, which has come. So the second forecast would come slightly closer to the monsoon period. But from an FMCG or generally a consumption standpoint, there was belief that this year maybe monsoon would be slightly lower. So there is not much of an adverse expectation or an adverse forecast that has come in, especially given the sort of monsoon that we saw last year. So below normal at 94%, more than, just the number, I think the spread, the intensity is extremely crucial, because these days what has happened over the last few years is that the quantum of the rains are pretty much normal, but at the same time, if you look at the kind of intensity that happens, the days of the rain and the spread is fairly skewed, so that will have an impact on agri.
IMD, we'll wait by for IMD's forecast as well. This is the first forecast. SkyMet is a private agency. We'll wait by for what the government also has to say on that. But very, very important from a consumption point of view, what happens with agriculture, etc. But moving on now, Finance Minister Nirmala Sitharaman says the West Asia conflict has evolved into a systemic tremor. She warned of an even more challenging year for the economy. However, she also went on to say that the government has the fiscal space to support industries and the Reserve Bank of India has the room to cut interest rates. Soon after the FM made these remarks, the Finance Ministry said that the comments on rate cuts are in the context of the government maintaining fiscal discipline and not in relation to the MPC committee's meeting, which is currently ongoing. Today is day 2. But listen in to those comments.
This current year is even more challenging as we move from a landscape of shocks to one of permanent volatility. The escalation of Middle East conflict has evolved from a regional security concern into a systemic tremor, threatening a vital arteries of global energy and hardening the lines of new multipolar world order. India has fiscal space, room to maintain our capex program, room for RBI to cut rates, and room to offer targeted support to affected sectors. This is the dividend of a decade of fiscal prudence and discipline.
Right, that is the Finance Minister speaking. We also have with us Mayuresh Joshi, Director Research Market Smith India, who's joined in. Mayuresh, good morning. So many updates that have come by. I'll ask you, one by one, but let's start with the jewelry pack. That seems to be doing extremely well. How much of the runway is priced in is the question right now. And on retail as well, both Avenue Supermarts and Trent reported decent performance, sequential improvement. And these stocks are off highs. What are your calls on these stocks too?
Morning, Mangalam. I think on the jewelry stocks per se, I think the fall in gold prices specifically, I think that might act as a trigger because the wedding season now will begin in full flow. And therefore, I think the expectation in terms of volume sales, both in terms of increased grammage, which has clearly been lacking for the industry as a whole, I think that might make some sort of a comeback. At the same time, margins which were relatively subdued over the past few quarters should probably have a stable performance as we head into Q4 and Q1 as well, along with expectation in terms of the studded jewelry, which should also probably make some element of a stability, both in terms of grammage sales as well as realizations. So in our opinion, again, I think numbers should be pretty stable and well laid out for a pack as a whole. But again, I think the expectation largely, Mangalam, getting laid out is there going to be far more consistency in terms of reported numbers? And therefore, among the large names, Titan is something that I watch out for within the mid-cap pack. Hangamile Jewelers is something that we are keeping a close eye.
Any thoughts on Kalyan and Senco? While your preference, you've made it clear, it's with Titan in the large cap space. But why not a Kalyan? Why not a Senco?
Morning, everyone. No, I think so. It's more in terms of consistency of reported numbers. So specifically in terms of how margins will probably play out both for Kalyan and Senco, I think that is going to be extremely critical in consistency in performance. Titan is largely underperformed within the large cap space for a periodicity of time. And therefore, I think is that it might probably start giving better numbers as we head into the next few quarters. Therefore, Titan among the large caps, and as I said, within the mid caps, we will watch out for underlying developers. Our own sense is that there might be a little bit of a salience factor in terms of better numbers reported compared to the rest of the pack, where Sangha might probably competes with.
In the banking pack, anything that stood out for you?
Again, I think the updates were relatively better for the pack as a whole. I think the only concern going forward is with the large banks specifically. I think how is deposit growth probably going to play out? With a large part of uncertainty playing out in risk assets, specifically equity markets, and the volatility that we've probably seen in commodities as a pack, is there some element of a safety flight coming back to fixed deposits? Is something to be seen. But again, I think within the pack, our preference still lies with the public sector universe because of the stickiness of the deposit base that they've probably got as we speak at this juncture. And therefore, I think expectations in terms of relative advanced deposit growth might be a little bit better off as far as the PSU universe is concerned. Asset quality pressures have probably remained very, very reasonable for the pack as a whole. Then therefore, both reported numbers in absolute terms, whether it's GNPAs and NPAs, reported NIMs, the CASA deterioration largely expected to be behind us, is something which makes us believe that the PSU universe might do a tad bit better than the private space. Within private names, our own sense is that a few of the larger names like an Axis or names like a Karur Vysya Bank within the mid-cap space can be watched out.
Do you have a call on any of these retail names that reported their numbers? We spoke about DMart, Trent, and Jubilant FoodWorks. What's your call there?
No, so I think within the retail universe as a whole, I think Trent, the commentary and the reported update is relatively better. But I think it's the same thing that happened last time, where the update on the top line and the volumes were relatively better. But I think margin was probably a miss. What they've probably done in terms of store expansions, which have happened quite significantly in the last quarter compared to the previous few quarters, probably make us believe that the kind of SSS growth, as consumption starts coming back, might be key drivers and enablers in terms of EPS growth and weightings as we see it in markets with India. But again, I think, Mangalam, to your point, in terms of the updates received, as you were just pointing out in your opening remarks, in terms of monsoons, what happens in terms of second round effects if the war elongates in terms of demand dynamics, consumption patterns, specifically in tier 2, tier 3 towns, is something to be watched out for. So decent update, but what happens to the margins thereof is something to be seen. So I think the way to watch, let's see what happens probably in terms of all these macro and micro factors unfolding at us.
Mayuresh, request you to stay on. We need to slip into a very short break. We'll come back and talk about the volume buzzers. We'll also get in a few technical ideas. Mitesh Thakkar and Sudarshan Sukhani join in as always. Welcome back. Let's talk about stocks which had great price action and very large volumes, delivery volumes. Hormus now joins in with that list. Hormus.
Morning, Rima. And the biggest factor yesterday for keeping the Nifty gains in check yesterday was Reliance Industries as the top loser on the index in yesterday's trading session. In fact, it has now declined in 4 out of the last 5 sessions that we have had. Monday's volumes were the highest in over a month for Reliance Industries. Close to 3 crore shares were traded, the 20-day average of 2 crore shares, and 50% of those shares were marked for delivery. So close to about 1.5 crore shares were marked for delivery, so around a 20-day average of 1 crore shares. And the stock was also the most traded yesterday on the Nifty 500. The other major performer on the Nifty yesterday was Trent. It was the top gainer on the index. On the opposite side, the biggest single day gain since August of 24 is the third straight day of gains for the stock, and in these 3 sessions the stock has gained almost 16%. Now the stock on the FNO side saw its 3800 call option being very active. The premiums there were up almost 140% yesterday. Volumes were the highest in more than 3 months. Close to 50 lakh shares were traded. The 20-day average is around 10 lakh shares, and a third of those were marked for delivery. So around about 15 lakh shares marked for delivery. The 20-day average of around 5 odd lakh shares. And despite this move over the last 3 sessions, the stock is down still well over 50% from its October 2024 peak. And among the banking names yesterday, a standout name was RBL Bank that did well in response to its business updates. The biggest single day gain since October of last year. Again, Monday's volumes the highest in 3 months. The 310 call option was very active yesterday. Premiums going up by almost 140%, with almost 2.5 crore shares being traded. The 20-day average of around 40 odd lakh shares. The delivery percentage though was the lowest in the last 3 months. Then only 40 lakh shares marked for delivery. The 20-day average of around 15 odd lakh shares, and the stock now is above almost 13 odd % higher than its Emirates deal price, which is around 280, and trading close to its 52-week high, which is close to 340 rupees a buy.
Right, Hormaz, thanks a lot for that. So those are a bunch of stocks which were moving around with a fair amount of volumes in yesterday's trading session. Let's go across to Sudarshan, who joins in with the brokerages, what they're saying this morning.
So first one is from aluminium sector. JP Morgan has gone ahead and upgraded both the major names Hindalco and Vedanta. Hindalco to overweight from neutral, and target is increased to 1125 from earlier target of rupees 875. For Vedanta, overweight from neutral and target is raised to 850 from rupees 680 rupees per share. It believes that there can be a substantial increase in the earnings growth over higher LME aluminium prices and favorable forex move. Favorable forex move here means that sharp depreciation rupee that we have seen over the last few months. Also, commodity tailwind should help ease recent debt concerns, and valuations have become attractive as per JP Morgan. For Hindalco, it believes the earnings have bottomed for Novelis, and FY27 should fare much better as Oswego plant restarts operations, and will also see an improved earnings trajectory in its copper business. Coming to Vedanta, risk reward has become attractive with FY27 expected EBITDA at 4 times, and earnings tailwinds in aluminium and zinc should more than offset weakness that we have seen in oil and gas. Next is CLSA has written on consumer, and here also there is an upgrade on few stocks. It believes that it has upgraded stocks majorly on the attractive valuations. It says Q4 saw significant QOQ increase in input cost and offsetting GST deflationary effects, and historically leaders gain on such sharp input cost increase that we have ever seen. It has upgraded Tata Consumers, Nestle, Jubilant Food and Swiggy to outperform, and upgrade AB Fashion to hold from underperform. For Tata Consumer, target is increased to 1193, Nestle to 1321, Jubilant Food to 520 and Swiggy to 357. And in FMCG, it favors food over household and personal care, and it sees recent correction in these stocks as an important opportunity to enter amongst major names like Tata Consumer, Nestle, Britannia and all the other names.
Thank you very much for that. Back to our conversation with Mayuresh Joshi of MarketSmith India. Mayuresh, any other stock that looks attractive to you that you'd like to highlight where you all have turned incrementally more bullish, you're advising your clients to buy ahead of the earnings season?
So, Rima, I think our take is that very selective spaces where the positivity might continue in terms of reported numbers, and mining as a space is something where our belief at MarketSmith India is that EPS RS rating should probably hold up. The updates have been reasonable so far. I think we're just flashing the updates of Sharp Metallics as an example, Lloyds Metals as an example as well. So within the pack, I think Godavari Power is something that we believe can do reasonably well going forward. Our own sense in terms of the backward integrated nature of its operations should hold up pretty well. They obviously get a premium in terms of their pellet realizations as we speak. The kind of power that is probably needed in terms of its operations is well laid out. and the expectations in terms of a large part of the mine expansion and the approvals that we've probably received, specifically for the Rani mine, which is a threefold increase, will probably ensure that the supply, as evacuation continues on a fast pace over the next few quarters, reflects relatively better in terms of volumes. Margins should hold up within the 20-22% kind of a range. And a very healthy balance sheet as we speak, even as the capex probably accelerates, it still carries a cash-rich balance sheet. And therefore, our sense remains that a lot of these mining stocks, Godavari Power, is something that we've kept on our radar and a part of our model portfolio. Sharp Metallics as an example, where valuations and expectations of earnings remain stable, probably in a base case scenario.
All right, so those are a bunch of stocks that you like. Thanks a lot for that, Mayuresh. What we'll do is we'll take a short break, come back. On the other side, we will have the pre-open rates. Karan Taurani of Elara Capital joins in to discuss the fourth quarter updates coming in from the retail discretionary space. We'll also get chatting with our technical experts. Stay with us.
Okay, welcome back. There's 9 minutes to go for the pre-open session to kick off. 22,880 is where we are trading at in the GIFT Nifty, at least right now. Sudarshan is with us. Sudarshan, good morning. Good to have you with us here. I mean, yesterday we got a pullback from the lows again. Today, the GIFT Nifty is indicating 160, 170 odd points lower start. And you know, that deadline is looming, which is tomorrow morning. We've had many deadlines, but tomorrow is another one. What's your sense, Sudarshan? Will we see markets stay low at some point? There will be interest at lower levels.
Yeah, good morning. I think it's a very unusual day today because of the deadlines that you spoke about and the fact that we've already rallied yesterday and the day before, or the last week trading day. So the trade, it's a very exceptional trade. The trade today is to actually buy put options and expect that something will go wrong in this negotiation and the markets are going to be weak and nervous. Now, this is a short-term trade, but for today itself, I think it's worth buying put options and carrying it till tomorrow morning. This is always a risk. The news can change to be optimistic. You have to be prepared for that. But this is the trade in the morning.
Well, that's an interesting one, Sudarshan, because over the last 3 or 4 trading sessions, you did say that maybe, at these levels, buying the dip sounds a better trade than perhaps selling the rally, but maybe protection is sought by virtue of puts and not necessarily exiting long positions. Is that what you're saying?
No, I'm saying take a short trade.
Okay.
Active short trade by buying put options.
Trade by buying puts. Got it. Take that point. Any levels that you want to highlight on the Nifty as well as the Nifty Bank?
Well, the Nifty, a sharp decline to 22,500 is quite possible.
Okay. 22,500 on the Nifty is a possibility. Mitesh Thakkar is with us as well right now. Mitesh, your call this morning, the GIFT Nifty is indicating a 170-point downtick at the open.
Good morning, Mama. So I think, to me, it looks like a very early signs of some kind of base being built. And the base is much lower from the current levels. It's around 22,300 or 22,200 zone. I think we've had about 3 or 4 intraday lows around those levels. And now we are at about 22,950. So roughly about 700 points lower, 650, 700 points lower from here. But in that phase, there could be some volatility. I think the idea is what Sudarshan also mentioned. I think buy closer to about 22,450. I think that's when you can start looking at long positions. First sign of reversal will happen once you start getting past 23,000 on a closing basis. And that will give you a target of around 23,430, 450 to begin with, and then maybe even higher. So for the timing, I think that choppiness might be slightly more. But if we don't break 22,250, I think there's a good chance that we might see some kind of a stronger pullback rally than what we have seen in the last few weeks.
Right. And how do you play this via stocks? So what are your stock calls this morning, Mitesh?
Yeah. So for the trade day, I think, I have a sell on Bharat Forge with a stop at about 1690 for targets of around 1630. Then I also have another sell call on Lupin, pharma was doing well, but Lupin is now showing first signs of profit booking and correction. So we'll take a very tight stop loss at about 2,300 and look for targets of 2,240 on the downside. Also a sell on BHEL. This is a stock, which in the last few weeks has failed to participate on the upside rallies. The slight direction of the indicators is negative. So a sell on BHEL with a stop at 250 for targets of 235 and one buy. Emphasis is the stock to look at on the upside. If it starts getting past 2255 and it's closed about 2235. So 2255 is the pivot. Above that, buy with a stop at about 2230 for a target of 2320.
All right. Take that point. Thanks a lot for that. Sudarshan, your calls?
Well, the calls are all on the long side, mainly because we are already considering going short in the Nifty. That's the broad market. Axis Bank is a buy with a stop under 1215. Nika is a buy with a stop under 245. Kalyan Jewelers is a buying opportunity with a stop under 410. And Titan is a buy with a stop under 4160. The buying is coming only if you're also going short in the index. Otherwise, they are both linked together.
That's a good hedge that you've announced out here. And the stocks that you've taken, all of them have decent fourth quarter updates backing them as well. But for the standout brokerage report of the day, let's go across to Nimesh, who is waiting by with this note. Nimesh, good morning.
Hi, Mangalam. So today's standout is in the banking sector. We heard, BofA's head of research yesterday talking about overall earnings. And today they've put out a big note on the banking sector with some preferences over private banks versus the other PSU banks and small banks. So they have turned constructive on the private bank names, and within that, their preference is towards ICICI Bank and HDFC Bank. However, on ICICI Bank, they've cut the target price marginally to 1,500, still an upside there, and they've cut the target price on HDFC Bank to 975, but still maintain a buy on both those private bank names, which is ICICI and HDFC Bank. They've made some big changes in the PNC Bank preferences as well. They've actually upgraded SBI to an outperform versus neutral earlier, and they've raised the target price on SBI to 1,200. Having said that, they've they've downgraded both Union Bank and Bank of India to neutral from buy earlier, and they've marginally cut the target prices on both those PSU banks as well. Interestingly, even on the small private banks, they've made some changes. They've actually downgraded RBL Bank, which is in a big momentum of late, to an underperform from buy. So it's a double downgrade on RBL Bank, and they've cut the target price to 325. That is a notable name there. They've also downgraded Federal Bank to an underperform from neutral, and they have a target price of 280. In that small private bank list, they have a preference over AU Small Finance Bank, and there they have a target price of 1,050. So big changes in the banking list for BofA. What stands out for me is a big upgrade on SBI to an outperform, and marginally cutting down on Union Bank and Bank of India.
Nimesh, are these all largely based on valuations or different profiles of the book and who's expected to take a hit?
Prashant, largely, post this crisis, they believe that if the war prolongs, there could be big earnings cut, and which is in the range of 3% to 23%. The highest earnings cut will come for the PSU banks and small private banks. And also, if you remember yesterday, Amish was very clear that they expect actually rate hikes going forward, which will mean it's more positive for private banks and lesser for small private banks and PSU banks.
Yeah, no, absolutely. And, all of this is going to hit sometime in the second quarter. We had Jairam of Piramal Finance who kind of sort of made that point as well. August is when he's expecting to see. Of course, it is a big if the war prolongs, he'd expect the hit to sort of show up sometime a few months down the line, not immediately. And that's the reason why, some of the quarterly updates that we've gotten so far have not seen too much by way of reactions on the upside, even though they've been strong, they've been good, by and large. Well, let's just revisit two names, Jubilant FoodWorks and Kalyan Jewelers. Mangalam, take it away.
Well, for Jubilant FoodWorks, I'm looking at it in the red, largely because of a couple of factors. The street was expecting the company to continue outperforming, and this time around, the revenue growth that they've reported is slower than expected. The stock did well yesterday. The stock did well in the previous trading session as well. Consolidated revenue growth of 19% is what they reported in the fourth quarter. Obviously, this includes a large part of their international business as well. What matters most is the domestic business, where the growth has been just 6%, and like-for-like growth as well, 0.2% for Domino's India, 9% for Turkey on a low base. So if you look at the chart, that tells you that 0.2% in terms of an LFL for India has been the lowest that we've seen at least in the last 7 to 8 quarters. So that's a cause for concern, a small one, because the company has already spoken about their aspiration of mid-single-digit LFL with 10% growth coming in from new stores. The growth from new stores has come in already. 59 new stores added in Domino's India this time around. So the last 1 year or so, they've constantly added 50, 60 stores per quarter. The important part, however, is beyond the fourth quarter. The first quarter is where you have the LPG crisis playing out as well. To that, the company had given an explanation on the exchanges where some parts of their portfolio might be impacted. And the first quarter is seasonally strong for them because it's one summer vacations. At the same time, we have the IPL. So there are reasons for more purchases of pizza. But this time around, by virtue of the LPG crisis, if there is lesser demand, then that could be a bit of a problem. No problems for Kalyan Jewellers or any other jewelry company, though. We have overall revenue growth rate of 64%. India operations reporting a revenue growth of 65%. Same-store sales growth of 45%. Well, a large part of that is on account of higher gold prices. Obviously, there could be some volumes coming back as well. International business did 45%. Candere did about 360%. Across the board, good performance coming in. And stock holding up in the green despite doing a 6% up move in yesterday's trading session. But with that, we'll take a short break. On the other side, we have Karan Taurani. All right, Karan Taurani is with us right now. Let's go across to him. Karan, Executive Vice President at Elara Capital. Karan, what do you make of the Jubilant FoodWorks update? I think it's softer than what most analysts expected.
Hi, Mangalam. Good morning. I think Jubilant is a big negative surprise, specifically on NFL. We clearly know that the base effect was playing out over the last 2 quarters because the company was showing NFL of in the range of 8 to 12%. So on that base, a growth of 5-6% is quite unexpected. But yes, 0.2% is like a huge negative surprise. I think if you look at all the other QSR companies this quarter, they have all reported positive SSG growth rate from fried chicken to burger category and so on and so forth. And the reason for that is I think most of these companies don't have a high exposure to LPG. In the case of burger category, the exposure to LPG is around 20-odd%. In the case of fried chicken, it's almost 45 to 50-odd%. So I think it's only Jubilant which has got a very high exposure to LPG. More than 95% of the outlets are LPG based. So this could have been primarily because of rationalization of menu in certain outlets. Otherwise, we don't see any other reason in terms of why the growth rates have been so low, because from an external environment standpoint, if you look at the pizza competitive intensity, even that is seeing a cool off in the last 6 months to 12 months, 6 to 12 months.
All right. So Karan, the problem seems to be the LPG issue for Jubilant Food. So if the performance was just 0.2% like for like in Q4, the LPG issue has persisted even in Q1, which means Q1 potentially could be a lot worse. Do you have any indication of what Q1, how are your estimates changing? And in that context, once you bring down the earnings expectations, how would the valuation of Jubilant FoodWorks look?
So firstly, this is an assumption that we are making that LPG could have led to this lower LFL growth rate. But let's assume that this is the only reason. So I think, as you rightly said, the month of March is factored in right now. And I think given the issue that we are, I think even for the next 2 to 3 months, you will at least see LPG supply issues or probably inflationary pressures on LPG. So for a company like Jubilant, next quarter, the LFL growth rate could go into negative trajectory in the range of 2 to 3% as well. Another negative impact for Jubilant FoodWorks, or rather for all QSR companies, is the food inflation cost. So I think inflation pressures are high in the range of 10 to 15%, specifically in the case of oil, in the case of other raw materials as well, and in packaging to a certain extent. So there'll be a double whammy negative impact. It's a high operating leverage business. If the SSG or LFL declines further from here on, you have margin pressures also in the next 3 to 4 months. But current quarter numbers, we expect a revenue downgrade of in the range of 2 to 3% basis this performance as of now, and earnings downgrade in the range of 6 to 7%. But if this performance were to worsen off from here on, this number could amplify.
Right. What do you make of the other retail updates that have come by so far? There's Avenue Supermarts. Obviously, store expansion is a positive out there. 19% revenue growth is what they've posted in the fourth quarter. Trent, not quite at their historic levels, but obviously there's some sequential improvement. So in light of the stock price corrections of both Avenue Supermarts and Trent, what have you made of their updates and what's your call if you have any?
So I think both these companies have reported a very strong growth as far as Storation is concerned. We don't foresee any kind of a major surprise on LFL SSG growth rate for both the companies. Specifically in the case of DMart, if you see, this is the strongest Storation growth rate that they've posted in many years. I think this actually gives visibility for FY27 growth rate. So DMart typically as a company was growing in the range of 15 to 16%. As far as revenue is concerned. This kind of rotation will add cushion for growth rates moving towards 18-20% in the near term. So that has led to re-rating of valuation multiple for DMart. So I think DMart, the revenue upgrades are in the range of 3 to 4%, earnings upgrade in the range of 6 to 7%, but the stock has moved up by 17 to 18% in the last 2 to 3 days, and that is largely because of re-rating of valuation multiple. So DMart, as we speak right now, it's largely there in terms of valuation, 67, 68 times F28. The most positive surprises for DMart could depend in how the margin assessment happens. So if we see a margin improvement, if we see acceleration on LFL in the near term, that could lead to further surprises. But otherwise, DMart is largely done as we speak right now. As far as Trent is concerned, again, over there, the surprise has been store addition. It's obviously come in the last 2 weeks of March because the first half of the quarter, the store additions were quite tepid for Zudio as well. But again, on Trent, West Side has seen the strongest store addition ever as far as numbers are concerned. West Side, Zudio both have added store addition of more than 20% odd. Now, this too provides some bit of cushion to Trend's growth rate over the next 2 years because the growth rates were pegged in the range of 17 to 20% as per estimates. And our estimates are 21% as far as revenue growth is concerned. So this kind of storation does add cushion for growth rates, which means that we may not see further downgrades from here on. But yes, Trend is a better stock to look at current valuations because the stock is currently at sub 50 times PE F28. And if we see momentum on growth rate towards 20%, and if we see margins being sustained in current environment, we believe Trend has got an upside of 5 to 7% from current levels.
Okay. Dhurandhar 2 has become an even bigger blockbuster hit than Dhurandhar 1. And I remember when we chatted with PVR management post Q3, they said about 30% of the box office collections in Q3 was purely on account of that one movie. Now Q4 will see the benefit of Dhurandhar 2. What would PVR's numbers look like, and is there upside in the stock?
So Dhurandhar 2 obviously has done well as far as box office is concerned. We had estimated close to 1,100-1,200 crores of net domestic box office. That's going to be largely in line. Now, for PVR specifically, this may not be like a big positive delta as per our indications earlier as well, largely because no other film has done well in this quarter except for Dhurandhar 2. There has been no large regional franchise film. There's been no Hindi film which has actually done well. Last quarter, you had other films also doing well, the likes of Kantara, and even there was a film, Avatar also, English movie which was there. So I think putting that into perspective, occupancy levels have been quite muted in this quarter because only Dhurandhar has done well. Second, you have to factor the point that Dhurandhar has not led to any big jump in footfalls. Obviously, footfalls have been healthy, but the majority of the spike because of Dhurandhar 2 has come in the ATP and the SPS numbers. So I think PVR right now from a revenue growth standpoint, the numbers will be strong. But from occupancy standpoint, they'll continue to struggle. And as far as margins are concerned, even margins will remain way below the pre-COVID levels, closer towards 10-12% EBITDA margin pre-Ind AS, largely because occupancy levels haven't come back to that extent. So PVR as a stock, valuations are compelling right now, largely because the business has going to become net debt free in the next one to 2 months. You will obviously see cash on books, return ratios improving. Content pipeline becoming slightly better as far as Hindi is concerned. So at this price point, PVR is a good bet.
All right, a good bet, but not necessarily only on account of Dhurandhar. What do you make of the, beauty updates that have come in? Nika, consistent growth in the 20s. Do you think it's in the price? And what do you make of the developments of the possibility of them acquiring, 82E, which is Deepika Padukone's brand? Obviously, doesn't add too much to their numbers, but takes out potential competition if there was any.
Yes, Nika has been one company which has reported a very consistent performance as far as growth is concerned, more than 20% in BPC. I think what has happened in the last 2 years is that quick commerce has come very aggressively on the BPC category. That had led to some bit of margin compression, some bit of lower take rates for Nika. But apart from that, strategically, they have gone right, wherein they wanted to protect their growth rates and not lose out further on market share. Second, of course, is that Nika internal competitive intensity within BPC remains to be quite muted. We haven't seen players like Tata, Myntra, and Tira scale up as far as online BPC is concerned. So they clearly have a moat here. But I think premium valuations for Nika are very much there right now. We have an accumulated rating on the stock with a target price of 270. The stock is valued at 85 times core BPC F28. So not much of an upside, but yes, from performance standpoint, things remain to be quite bright for Nika. Of course, the surprises for Nika to watch out would be the margins. So margins have corrected in the last 2 to 3 years as far as online BPC is concerned. That's primarily because of lower take rates and the competition from QC. If we see a margin reversal, you will see upgrades for Nika as well in the near term. As far as the brand of Deepika Padukone is concerned, as you mentioned, it's a very small brand, but the focus remains to be on private labels, on creating brands. I think what Nika has done with many of their private label brands is that their dependence of revenues from Nika as a platform is very small. And they're actually spreading to other horizontal platforms, other BPC platforms, and even some offline channels. So I think that is a very good sign to scale up the brands. And you'll see improved margins also because of the overall portfolio moving towards private labels.
Take that point. Karan, just a final question before we let you go. We also have staples. It's such a weird time when earlier, when we spoke consumption, staples were the top of mind. And now as we speak, the last question is on staples. We had the update that came in from Dabur, Godrej Consumer. What are your expectations from the updates that have come in so far and the biggies here, HUL, etc.?
So I think from an FMCG standpoint, things are looking slightly better as compared to what they were about 2 to 3 months back. But very clearly, we have to watch out for inflationary pressures in the near term. With the medium term, we also have to watch out for channel mix change, because once these businesses move towards online mix channel, you will see some bit of margin pressure as well. But as far as growth is concerned, definitely things are improving.
Karan, thank you very much for joining in. Look forward to our next conversation. We've got about 4 minutes to go before we open for trade. Let's get in a few calls then. Sudarshan, what's your 910 call?
It's Titan. Buy Titan with a stop under 4160.
Buy Titan. Mitesh, yours?
I'll go with a sell on Bharat Forge for targets of 1630.
While Bharat Forge's March Class A trucks look good on a year-on-year basis with a growth of 130% plus, on a month-on-month basis, it has fallen by nearly 19%. So you could perhaps feel the impact of the war there. Month-on-month, the Class A truck orders have come down. Maybe that's putting pressure on the stock. Mitesh goes with a sell. Vivek now joins in with more on JSW Infra. Vivek, why are we watching it?
Well, good morning. Interesting note coming from JM Financial as far as JSW Infra is concerned. Remember, mid-quarter, the company did update the exchanges saying that, one of the terminals as far as West Asia was concerned, which is the Fujairah liquid storage tanker, was actually impacted by drone attacks that were happening during the course of the war. But what JM Financial says is that despite that, they expect FY26 EBITDA guidance of 2,600 crores to be largely met despite disruptions. But they've gone ahead and cut the target price to 365 rupees a share from earlier 400 rupees a share. So what will help the company go ahead and meet its guidance? Number one, they're expecting the strong performance from the group-linked cargo to continue to do quite well, and they also expect continued scale-up as far as the logistics business is concerned. Now, key to watch out for as far as JSW Infra is concerned is that, remember, the promoter shareholding in the company has to come down. So potential plan for a primary fundraise is something that will help, number one, keep the meet minimum public shareholder norms, as well as help the company keep its net debt to EBITDA ratio below 2.5. That will help further expansion. So overall, a slightly positive note coming in on JSW Infra from JM Financial.
Thanks very much, Vivek, for that. We've got 2 minutes to go for the market open to come up. Here's a quick recap of some of the stocks that we put out from the morning. So stocks include Gujarat Pipavav, Titagarh Systems, KEC International. They're all small changes for now. This is the indication from the pre-open session. There is HPL Engineering, Kernex Micro, both those up a little bit. Fino Payment Bank and Credit Access. Credit Access is up almost 4%. Fino is up 3%. And Kalyan Jewelers, Godrej Consumer, Jubilant Foodworks. Some of this, of course, we've discussed extensively over the last 1 hour. So Kalyan is up about 3.5 odd%. Jubilant is starting down about 4.5 odd%. So that's the picture. Let's just look at the Nifty as well. So Yeah, I mean, settled down 130 points. The sensex is down about 370 odd points or so. I mean, if you really believe that this is a bit of a binary situation, binary outcome tomorrow morning, then, I mean, markets are not well suited to judge binary outcomes one way or the other, positive or negative. So, we'll see what happens. But typically, markets will assume that the logical thing happens and it doesn't escalate and it de-escalates, which would be the logical thing to expect. But sometimes illogical things happen as well. What do we have? 1% cut on the Nifty, 22,750. You got the Nifty Bank, which is down about 1.25%. It's about 220 point lower on the Nifty. The sensex is down a full 1%, which is 700 plus points. Small cap index is down 1, and the mid cap index is starting down about 1.25% as well. So it's almost split right in the middle, 1:1, 660 up and 660 lower. So that is the advanced decline right out of the gates, but this is the initial first cut. Look at where things are opening up. So 2 names in the green and everything else is in the red. You've had 2 days of sharp recoveries from the lows, so you've got to perhaps account for that. And then there's this deadline tomorrow. Indigo, Eternal, iShirt, Tata Consumer, L&T are some of the top losers, and Wipro and Hindalco are the only 2 which are up in the green. So that's the Nifty picture, the heat map. But let's take a wider look at where other stocks are opening. Rima.
Well, for Hindalco, it's the JP Morgan upgrade to an overweight. They believe the earnings have bottomed out for Novelis, which is why it's an overweight call for Hindalco with a raised target price of 1,125. So that's supporting Hindalco, top Nifty gainer. Wipro numbers towards the middle of this month. The street is expecting a potential buyback. So that could be keeping the stock a bit excited today. So Wipro, while the rest of the IT stocks, large cap IT names, are struggling a bit, muted, Wipro is still up nearly 1%. ONGC managing to hold up in the green as Brent crude prices continue to remain elevated. Well, on the way down, the top losers include many of the consumption names which did well yesterday. So Avenue Supermart straight away 2% down. Tata Consumer, Nestle down 1.5%, nearing a 2% decline. Trent is correcting. It was a 7% up move in Trent yesterday. Following the Q4 update, 20% top line growth. Today, Trent is seeing some profit booking, and that stock has given up nearly 1.5%. We should pull up Reliance Industries. That was the culprit yesterday. Didn't participate on the way up. Stock was down 3.5%, and Reliance Industries has opened up with a fall of about 0.5%. A little less than the overall benchmark decline. Banks are underperforming today. So the Nifty and the Sensex are down 1%, but the Nifty banking index is down 700 points, 1.3% lower. And large banks, whether it's Axis Bank, State Bank of India, HDFC Bank, all under pressure. HDFC Bank too, down nearly 1%. So it's broadly all red. The mid-cap index is selling off a little more sharply. The mid-cap index is down 1.5%, and the advanced decline ratio stands at 2:5. That's about 600 stocks advancing for 1,600 stocks in the red right now.
The stock of the morning, this on account of the fourth quarter update, has to be Jubilant FoodWorks. A weak update coming in. The stock is down 7% right now. So that's the kind of sell-off that we've seen. And I think the weakness in Jubilant FoodWorks is reflecting in all the other QSR players as well, including the likes of Eternal and Swiggy. The case being that if Jubilant FoodWorks has had a smaller same-store sales growth, maybe the wider universe of restaurants would have curtailed their menus, and that could have an impact on Eternal as well as Swiggy as well. A 6% downtick is what we've seen on Jubilant FoodWorks. But what's doing well is the jewelry pack. Kalyan Jewellers, after a 6% up move yesterday, continues to add on today and a little more, 2% on Kalyan Jewellers after their 65% growth that has come in. The smaller jewelry companies as well doing extremely well. We have PC Jewellers, which reported their update, doing extremely well. The JP Morgan note has had an impact on Vedanta too. That's up around 2%. And Godrej Consumer, a high single-digit volume growth, low double-digit sort of revenue growth has had the street excited. So while all the staples are selling off this morning, we have Godrej Consumer, which is up by about 2%. And some updates doing extremely well for the financial names as well. Credit Access really stands up. Gross loan portfolio up 14%, disbursements rising about 28%. That stock is up 9% and counting. Shyam Metallics as well, a 58% jump in their stainless steel volumes and a 19% jump in their realizations has that stock higher by about 4%. And finally, we do have Brigade Hotel. The signing of 2 hotels has done well for them in an otherwise weak day for all the hotels as well. So the industry leader, Indian Hotels, is lower, whereas Brigade Hotel Ventures is up around 4%. So by and large, it's all business update related, and the moves are fairly sharp on either side.
Absolutely. Well, 180 actually down on the Nifty. 22,780 is where we are opening at this point in time. It's 1,500 down and about 900, actually 1,000 higher. That's the declines to advances ratio. So more down than up. The problem is that all of these things, that microfinance story starting to come back, the worst behind. Some of this stuff with regards to Iran, from an India economy perspective, is happening just as things were starting to improve around a range of industries. We were having that conversation earlier with Karan Turani on, QSR, etc. Things were starting to look up, and now you've got this, which will show up, maybe not immediately, but if it continues with a lag. Manish Sonthalia is with us, CIO, MK Investment Managers. Manish, of course, when we've spoken earlier, you'd been sounding positive and constructive. But this is, of course, I think our last conversation was at least a month old. So before the war started. Has this changed your view in any way, Manish, in terms of how you're thinking? From being constructive to a little cautious, or you remain pretty bullish?
So February 28, we had this new variable come onto us. And, we are not finding any diplomatic solution. So I think, the whole outcome of how the outlook was going to be looking like for the near term is basically whether we are going to see a military reset or a diplomatic reset. And as of now, it does not look like to be a diplomatic reset. It's looking like more a military event. And it's a supply shock, an inflation shock, a supply chain disruption, which will feed into growth shock and, demand reset. So just like the COVID times, we are looking at the external exigency in terms of the shock that is coming through from Iran. So that is how we are looking at. And I think base case earnings numbers for FY27 and 2027 for the time being looks reset on the downside. No longer going to be 14-15% sort of a growth. I think more like 12-13% sort of a growth. And that is why we are seeing a reset on the downside. So I think all in all, whether it's going to, and this next 15 days or next 2 days, whether it's going to be hit very hard will mean that whether it's going to be a second order demand destruction and economic compression and reset of consumption, investments, energy, subsidies. All of these things are all in the air currently, and we are still trying to find out how the situation is likely to play out.
Yeah. Look at the market, right? Trying to come back up, down only 140 odd points. So about 0.75% lower. So the market still wants to believe that this is not going to... It's not, by the way, it's not as if the attacks on Iran have stopped or conflict has stopped in terms of the actual war. But there is just this threat of as further as, and it's not even as if civilian infrastructure has not been hit in that country. And we're talking about schools, universities, and of course factories, industries, steel plants, all kinds of things. But there's just a threat of all of that being stepped up dramatically. That is the threat. So it's not as if it's peace now and tomorrow morning it suddenly is going to be all very different, perhaps intensified if it does come to it. So Manish, you're saying 13%, right? We had Amish Shah of BOFA yesterday who said that he's expecting now 8.5% earnings growth, Nifty FY27, 8.5.
I mean, we got to see how it plays out. But, if this prolongs, then obviously it's going to be a further reset. But currently, I think 2% is par the course. And further escalation and further LNG disruptions and oil price disruptions will mean further downside to earnings. But currently, and mind you, if this is a supply chain disruption, it's not going to reset very, very quickly. You basically going to see FY27 being a washout year and markets will try to focus on FY28. FY28 would mean a more normalized year, 15% sort of a growth. But FY27, till we have a clarity on whether it's reset or not reset, everyone will have their own estimates.
Are you seeing any slowdown in the money which is being invested coming into the PMS AIF industry so far? Because returns are tough to come by. Has money slowed down?
I'm given to understand that this month's SIP numbers are going to be slightly lower than the last month numbers. And similarly, the same outlook is there for the alternates industry. So, flows are coming in, but they are coming in by way of a trickle as opposed to what the numbers were looking like a month back.
Amidst the correction that we've seen so far, do you think that there are opportunities to, pick some stocks or sectors which were earlier higher and now are, not as impacted by the war, but the prices have come to an attractive level?
Across the board, we are talking about Nifty 50 valuations are closer to COVID numbers, this 18, 19 times. I mean, how much lower you could go? I think valuation at 17, 18 times is supported. It's just that what the numbers are going to be looking like on the benchmark. There has been a significant amount of correction across the market. There is value across the spectrum. It's a pick and choose. So wherever there is earnings comfort, and I think some of the sectors which are likely to be resilient in this difficult phase is where there is going to be resilience. So, you have fossil fuels energy being at the center. So something like power and focus on renewables and electric vehicles and batteries, they will be more or less resilient. Financials, they'll have a superlative number going into the fourth quarter, and hopefully you should not see too much of a reset on the credit cost, and deposit accretion should be good. So financials again looks good. Or you could look at defense because there's impetus on defense expenditure, which is not impacted by so-called the disruptions that you are seeing in the Middle East. Consumption, again, where there's pricing power, they are likely to be more resilient than the rest of the pack. And mind you, we have seen correction across all sectors. There is no sector which has been left out. So I think it's some of the resilient sectors which are likely to outperform going into the next one.
So finance, defense and premium consumption. Even technology. In the past, you've said that the entire sector has seen enough damage. There is a significant margin of safety. Are you looking to buy tech stocks, or have you all been buying?
Yeah. So we are invested in technology stocks. And mind you, in India being an anti-AI play, and now that energy cost, the building block of AI infrastructure itself gone up 75-100% in the last 1 month. So, this theme of an AI taking over, AI is here to stay. So for the time being, because energy costs are very high, the thesis around anti-AI and India being not a part of the AI, tech stocks actually seen a lot of correction. We're going to see some sort of a pullback. Even for the fourth quarter, numbers are going to be good, because of rupee depreciation and because of the resilience on some of the mid-cap names. We're likely to see around 10 to 12% sort of a YOY earnings growth. And mind you, all these technology companies are trading at 4, 5, 6% free cash flow yields. I mean, they are basically pricing in zero growth. So as against that, if you have a 10 to 12% growth, I would find value there.
Take that point, and as we speak, the IT index is actually at the high point of trade, and that's the one that is actually, taken the Nifty off morning lows. The Nifty is now cut its deficit to just about 90 points, and that's a big recovery that we've seen. Even the Nifty Bank, which at one point was lower by over 1%, has now curtailed its losses to just about 400 points. So the buy on dips so far has, played out early in the morning to call that out, but it definitely looks like there are people who are looking at lower levels as attractive opportunities.
By the way, advanced declines advanced become advanced decline now.
Yeah,
so 1,700 stocks are higher and 900 stocks are lower. So if you have the NSE, there you go. That's the picture. That's pretty stark, right? From the morning, it's completely turned. So broader markets, we've been seeing this action for the last 3 days now, and actually last 2 days, last Thursday and yesterday as well, and it is the case today as well. VMart, once again, right, third day of strong gains on VMart. 5% is a top volume-led gainer this morning. There's Hindalco, which is up 3 1/3%. There's a brokerage call there. Vedanta is up 2.6. So metals are doing very well. There is RPSG Ventures, which has gone up like a rocket. From 600, it's basically doubled in about 7-8 days. Yeah, it's doubled. Then there is GMDC, lots of metal names. Garden Reach is up about 1.25%. Titagarh did well yesterday. That's up about 3%. Data Patterns is up 1.25%. Ganesha Ecosphere is up sharply, actually. in the last 3 days, from about 700 to 1100 in about 6-7 trading sessions. Premier Energies is up about 2.25. Chola Finance, Shakti Pumps, and so on and so forth. So yeah, I mean, the color texture of the broader market is also starting to turn, and there is definitely interest which is there, which was not there till the middle of last week even. So starting last Thursday, that seems to have turned, and there is this buy the dip kind of mentality which is emerging. Let's see if it holds. Manish, run us through what you find attractive. If you're able to talk us through 3 names with some fundamental analysis.
So basically, giving out names is not possible. But I think, in this backdrop, some of the capital market players look very good, particularly those who have reported business updates, etc. And numbers are likely to be better this quarter. Or you have the financials, the public and the private sector banks. They have fallen enough. And we've seen the business updates coming from there. They look pretty good. Automobiles, some of the electric vehicle names, new age companies, small numbers per se, but hyper growth coming in the next 2-3 years. They are almost trading at all-time high. These are some of the names which look pretty good.
Any sector which is a complete avoid right now, where there could be further downside from here on?
Travel, airlines, travel, hotels, because there's cost increase across the board, more so international than domestic, and within also domestic, because of fear of inflation and cost increase, there is some postponement. So this is one area. Real estate, again, these sectors are meant for good times when there's ample liquidity, low cost of capital. Of course, some of the valuations, if you were to take a 3 to 5 year view, are completely mouth-watering. Particularly in niche markets like MMR and NCR. So again, you have seen high reset out there. Some of the AI thematics like co-working, etc., getting impacted on valuations. Valuations have come to 1/3 of what these valuations were, 1 year back or 1.5 years back. I mean, it's not so bad per se. So I would find great value out there. Some of the staffing companies are trading at 15% free cash flow yield. I mean, these are very hard to believe, even though prices do seem to suggest that there's not going to be too much of continuity in the business model. So a lot of distortion in prices and values, and there you have opportunity.
Manish, so you said travel, tourism, etc. perhaps avoids, right? Because there is disruption, pain, etc. Should at a time like this, should you take the longer view or take the more tactical view? Tactical is harder to do. Longer is easier to do.
Yeah, that's the easier part. Timing the market is easier said than done. Of course, we all try to time the market, but human beings are not wired to time markets to perfection. We can broadly understand whether the markets are somewhere near the bottom or somewhere near the top, and we should just stay at that. So taking a slightly medium-term view is going to be advantageous. Today, the valuations are very, very good. Near-term outlook, FY27 is all up in the air because of the external exigency that we are seeing. And how that resets will mean that, as in the case of previous wars, 10% or more correction, the Iran-Iraq war, we saw a 10% correction. Now in this Iran war, we are already seeing a 10% correction. And as in the case of any other war, the reset, whenever the pullback happens, is fast and swift. So something like that is likely to play out. So there is value, and the world never comes to an end. Life goes on.
Yeah. No, so then that travel tourism, which you said perhaps avoid, it's not on with a slightly medium-term perspective, isn't it a attractive
Hotels
sector?
are fabulous business, Prashant. Hotels are fabulous business, And given the demand-supply scenario, even if you assume a 6% growth, real GDP growth in INR terms in India, we are massively short on hotel rooms, and supply cannot increase beyond 5% every year. And the total number of hotel rooms in the country is maybe 350,000 or thereabout for a $4 trillion economy. So, or $3.5 trillion economy. So from that point of view, these are great plays. Similar to your COVID times, where we are all sitting at home. These sectors were hit very badly, but when it again reset back to normal, you saw some exemplary gains come through in these sectors. So likely to play out going. So it's not a sell. if you want to avoid, don't want to go through the pain of a price correction in the near term, so be it. But in the medium term, long term, they are good buys, particularly when you have, let's say, the airline space, you have a monopoly in one of the names. I mean, you could always look at that, and the hotels and the tourism travel.
All that. And your thesis is that we're closer to the bottom than we are, than we were, say, earlier, right?
Absolutely. Of course, as I said, valuation of 17, 18 times, these are COVID time valuations, and we are nowhere close to COVID time. And war reset of 10% or below, we have seen only during Iraq. And, this external exigency is not yet fully priced in on a global basis. And because, Southeast Asia, energy dependent, food dependent on imports, we'll also be feeling the impact. But the pain is going to be more transitionary, short term than long term. So you can see the glass half full or half empty. I would believe that if you look at the glass half full at this point in time, that would present more of an opportunity in a crisis.
Do you have a call on the platform companies? Because, they too have seen a big correction from the top, say, Eternal, there's Swiggy. A lot of people believe that maybe, domestic consumption, if that is a thesis which continues, urban consumption in particular, quick commerce, this could be an opportunity right now, the 30-40% downtick that we've seen from the peak. And some stocks like Urban Company, etc., are now available very close to their IPO prices.
Yeah, many of the new age companies are trading at the IPO prices. Some of them definitely worth mentioning. Eternal, which we own. So, the competitive intensity has come off slightly. And even today, in spite of all the, the disruptions that we are seeing in the food and the retailing quick commerce space, I think we are still standing with the 60,000 crore GMV on the quick commerce side going up to 150,000 crores within the next 2 years. And, if that be the number and competition is somewhat weaker, then they would be the best in terms of capturing the margin. Of course, why has the stock corrected from 360 to 220 or whatever? There can be a lot of reasons, because it's a largely owned stock, institutionally owned, foreign investors owned, and they may have their own reasons for sell-off and all. But I do find great value in Eternal at these levels. Some of the other new age companies like Pine Labs, Grow, I mean, these are also part of our portfolio. I do find great value. Urban Company looks interesting, but we have got to do our numbers on this.
Manish, up until now, the problem has been a supply disruption. But when you speak to companies, your team speaks to company, is there any sign of demand destruction that's already crept in? Maybe it will come in once the conflict prolongs. But as of now, are there any signs, because consumer sentiment has been hit, there is fear, which is palpable in the air, there is demand destruction or not yet?
No, corporates are not talking about volume degrowth or volume, compression as of now. Guys are only talking about margins. Margins and the outlook on margins going forward is likely to be somewhat weaker, and obviously because raw material cost, metals, commodities, etc., is looking weaker, and because of the supply chain disruptions. But fourth quarter, I mean, we are just about beginning the new year. If this was to get prolonged, this $100 inflation resulting into cutting of consumption, etc., will manifest itself if this was to get prolonged. But as of now, till the fourth quarter, not so much of an impact on the demand side per se. In fact, some of the pass-through of the festive period will get felt on the positive side in the fourth quarter. Fourth quarter numbers should not be extrapolated into the first quarter numbers, because reality could be very, very different. And, once these two state elections are there, how the oil prices, etc., reset, and urea subsidies and food subsidies and oil subsidies, they will have an impact on consumption, investments, subsidies. How is energy going to get rationed, and what's going to be the reduced industrial output? All of these things are variables which will be known in the first quarter and beyond. But till now, no commentary majorly on demand compression.
All right, it's all happening as we speak, Manish. Thank you so much for joining in. Prashant, look at the advanced decline ratio once again. We have them fighting neck and neck now. 1355 stocks in the red for about 1300 stocks, which are in the green. So those lines, the market's actually trying to make up its mind, right? On the one hand, there is a floor which has been put. Perhaps the street says that, okay, there could be buying at lower levels, but at higher levels, those who have bought are perhaps curtailing their losses, or at the same time maybe booking some of the profits, whatever they're making, as well. A 3 days of gain is what we've seen on the Nifty, and the cuts are extending on the ones which weren't doing well. So Jubilant Foodworks for one, opened 6% lower, now down 8%. Bharat Forge, over 130% jump in Class 8 truck sales. That stock is down about 3% because the street believes that maybe going forward, whether this sustains or not. Force Motors down about 3%. Across the board, there is selling, and the ones that were gaining are also off highs right now. Godrej Consumer at one point was up around 4%, now up around 2.5%. Vedanta and Hindalco as well, which were higher in trade, still higher in trade, but marginally off highs. No worries out there. In fact, there's a brokerage note that has come in. Metals as a sector is doing well today. Hindalco, Vedanta in particular. Sudarshan joins us back. Sudarshan, JP Morgan positive on these names.
So they have upgraded both these names, Hindalco and Vedanta. Hindalco to overweight from neutral, and target is raised to 1125 from the earlier target price of rupees 875. And for Vedanta also, it's to overweight from neutral, and target is increased to 850 from earlier target price of 680 rupees per share. It sees significant increase in the earnings backed by higher LME aluminum prices and favorable forex move. Favorable move, basically they mean by saying that there is a sharp depreciation of rupee in the last few months. Also, commodity tailwinds should help ease recent debt concerns that these companies had, and valuations, as far as valuations is concerned, it has become favorable also. For Hindalco, it believes that earnings have bottomed for Novelis, and FY27 should fare much better as Oswego plant should restart the operations. It will also see an improved earnings trajectory as its copper business is seeing a growth in the earnings. For Vedanta, risk reward has become attractive with FY27 estimated EBITDA is seen at 4 times, and earnings tailwinds in aluminum zinc should more than offset weakness that company has been seeing in the oil and gas space. So positive brokerage note is helping a higher move for both these names.
Thank you very much for that. Let's now invite the management of Blue Star on the show now. B. Thiagarajan, MD of Blue Star, is now joining in, and some of the discussion points are up for you on your screen. Thank you very much, sir, for joining in. First, just wanted to get a check on how this summer season sales have been for you. When we last spoke to you, you said assuming a normal hot summer, sales should be 20 to 30%. Has that been the run rate for the summer sales that we've seen, say, in the month of March and expected in April and May?
Good morning, Nika. It is a pleasure interacting with you. It's like toss one, elected to bat, power play, but the first over is maiden. So far, summer has not picked up. So having said that, there is enough time for us to wait and see what is going to happen. So in the last interaction I had mentioned to you, I won't be able to comment specifically on March because of the silent period, but the season began with quite a bit of headwinds. The first one is when the summer will set in a real way. 2, the price hike that is to be passed on to the consumers, because it is unprecedented. Close to 13% is the price hike to be passed on. Some 5-6% has been passed on already. The balance is yet to be passed on once the demand picks up. The third is the war and related sentiments. So I had mentioned that the summer season will be an interesting one, challenging one, and we are keeping our fingers crossed. So far, summer has not picked up. You would have watched Calcutta, it rained, and this morning I am in Delhi, it rained here. And sporadic rains are happening across, but the outlook is that the summer is going to set in at some point of time. Perhaps it is a late summer. That's where we are.
That's a great analogy that you've given. It's the power play over and the first over is gone. Power play period and the first over is gone for a maiden. I noticed that there have been unseasonal rains and summer hasn't really set in. And at the same time, last summer wasn't very great either. It was a lost year for you. So do you believe that this year, on that favorable base, 2 bad summers could actually have a bigger problem when it comes to structural inventory holding for your dealers?
Mangalam, I had stated that I have not, in my career for over 4 decades, I have not come across 2 seasons consecutively failing. But I think summer will set in at some point of time, and obviously there will be growth compared with last year for multiple reasons. Last year itself was bad. and there has been price increase. So therefore, in revenue terms, it should show a double-digit growth. As of now, that's what we will look forward to. Having said that, as far as Blue Star is concerned, that we have been talking about that there should be mitigation through B2B businesses, whether it is room air conditioners itself getting sold to institutions, or commercial refrigeration products, or the electromechanical projects like data center. That's how last year we managed. And I think we will continue to focus on B2B as well. While I have not yet written off the summer season, there have been instances when summer sets in a bit late towards the end of April. Perhaps we are heading towards that. But the important thing is the sentiments as well. The war will have to end, and that's what we will pray for.
So this is Mr. Dagaran, good morning. Prashant here. I think, guys, the only time where everyone hopes for a hotter summer when we have, when we're speaking with AC companies. All right, Mr. Tyagarajan, good morning, sir. Prashant here. So what has been what have sales been like so far, sir? Give us some indication, broad indication. What are normalized levels of sales? Normalized levels of sales at 100 so far, anticipating a proper normal summer. Where are we now compared to that baseline?
I think it is flat so far in the secondary movement in the markets. And actually, summer sets in Kerala. So if you look at the first 5-6 days of Kerala sales, it is very bad. The Middle East sentiments are very high there, right? It is almost minus 40% there if you look at Kerala. And other parts, it is flat. But one looks forward to after a bad summer of 2025, it should have been a very big sale that has not yet settled. One will have to wait. See, we are not talking about the baseline sales that anyway will happen. It's not that market is going to shrink. We are talking about growth of over 25-30%. That is not yet happening.
Yeah, that's what I meant. I mean, if normalized sales for this point in the year are about 100, Kerala is say 60. What is the average across, sir, for you right now?
It should be somewhere around the same figure of 80 or so across. But the first 6 days is never an indication, right? So you have to wait and see. I am still hopeful that this summer season should post a modest growth over and above the price increase. Which means one should look at least 20% revenue growth, then around 10% coming from price increase, 10% coming as a growth over last year. I think that is what is likely to happen.
But that's a serious disappointment, right? Because last summer was weak, and on top of that, the street was anticipating 25 to 30% growth. Here now you're curtailing down it to 20%, and that too 10% coming in from price hike and 10% coming in from volume. So that would disappoint the street, right?
Perhaps I'm saying this is the minimum one should expect given the situation, but we will wait and see. It is not yet lost. As I told you, it is 1 over maiden, 19 more overs to go. That's what one should look at.
Only problem is there's no timeline on these innings itself, right? How long I'm referring to the war and the conflict in that sense. Mr. Dagaran, how large is Kerala as a market? Because there is it's the steepest decline there because of Middle East sentiment, linkages, etc. Is it a large market for you?
On all India basis, it will be around 4-5%.
4-5%. Got it.
So would you rethink on the price hike? You said you need to pass on hikes to the tune of 13%. Of that, 5-6% is done. So there's still about 8-9% that's left. Considering the consumer demand has been hit so far and you want sales to revive, would you rethink on a price increase the next round?
No, it is very important that that the operating margins are maintained, right? 0.5% or 1% is okay. It is not an industry plague with very high margins at all. So one will have to be careful. Okay, you will control the costs and optimize the certain expenses like perhaps the advertising, promotions, etc. But it is not possible for the industry to absorb this unprecedented price hike. You look at now further it will go up post summer season because of the plastics and other input material which are all already rising. So the industry cannot afford absorbing these.
Okay, so a price hike is unavoidable. So when is the next price hike? And after that, once the conflict settles down and we come to know what the prices of polyester, plastic, etc. is, will there be another price hike?
You have to wait post-war what is going to happen. There is enough material, raw material as well as finished goods. Summer is taken care of. One would worry about the festival season. Again, it will, if it is a good summer season, I'm saying 20 to 25% growth we have managed, then you have to wait and see what is going to happen to other commodities, like whether copper is going to come down, steel will stabilize here. We do not know at all. It is a very uncertain period.
What about LPG, Mr. Tyagarajan? Apparently, LPG is heavily used, sir, in something called heat exchanger brazing. It's a apparently critical process, a step in manufacturing. Is availability an issue there, sir?
Not at all. In the sense that there is a concern, but it is being mitigated. Like there are alternate methods of brazing known as oxyacetylene. We also use LPG and PNG in powder coating. Again, diesel power can be used there. The question is the cost of commercial fuels going up, but that is insignificant compared with Prashant. At this moment, the industry as well as Blue Star will look forward to summer kick-starting and the war coming to an end. Both are not in our hands, unfortunately.
Right. Just a two-part question before we let you go, Mr. Tyagarajan. Then one is, what's the kind of inventory at the dealers right now, and how do you expect that to pan out as compared to what it usually is ahead of summer normally? And the second part is on your own personal market share. When the industry itself is facing a tough time, everyone jostles for market share. You've been gaining market share. What's your target here?
We are marching towards that 15% market share, and I don't think that will be a challenge. The question is, it is market share of what kind of market?
Exactly.
The penetration levels have been lower. The industry has to take off in a very big way, and hopefully. I pray that the summer happens. So market share is not an issue. We will get to 15% market share, which is the next milestone for us. But 15% of what? That's what is the important thing.
And the inventory levels?
Inventory levels should not be a major concern. Probably 60 to 75 days of inventory is very common, but the sellout will have to be very high, which is not happening. This inventory worry will begin, in my opinion, by around April 25th. Till then, it's fine to hold that inventory, because as far as the dealers are concerned, they have got this inventory at old prices. Okay, so therefore the consumer also will not be seeing a burden. The new inventory will be the burden. So right now everyone is happy that there is enough inventory in the channel and waiting for the demand to pick up.
Okay, all right. Mr. Tyagarajan, we'll wait how the season progresses and whether the heat picks up. Hopefully things, I don't want to say things get hotter. Things are hotter in other ways everywhere else in the world, but hope business is better as we proceed into the season and it's more regular.
Use
in that sense.
His analogy itself, we can say, may you get a few loose balls to knock it out of the park and probably get a better score by the end of this.
May is too late. It has to be next week.
I said maybe, not the month of May.
I think we need some no balls and wides as well. So it will happen.
All right, Mr. Jagadan, thank you very much, sir. Appreciate you joining us, and really thank you for your time. We'll speak again. We'll take a quick commercial break here. 120 lower on the Nifty, 22,850. And market breadth is flipped again. 1,500 lower and about 1,200 higher. So very, very fluid situation. We are back with Manisha, who's going to focus on what's happening with the commodity space. Stay tuned.
Back, still holding lower for the market, about 100 points and more decliners than advances now. But commodities, they are on our radar. Manisha, as always, joins us. Manisha.
Thank you for that. I'll start with the crude oil prices, where we are holding strong gains. 111 for the Brent prices, 115 for the U.S. crude prices as well. Well, it clearly is about the U.S. deadline to Iran at 8 p.m. Tuesday, and then a 45-day truce as well being introduced. So what we do understand, as per the latest reports, is that Iran has rejected a temporary truce and is asking for a permanent solution. So that is where we stand right now, and that is a premium that we are continuously looking at in case of prices when it comes to energy. OPEC Plus, in a further statement, has said that they're looking to increase output by 206,000 barrels per day from the month of May. But the markets do understand that this increase is mostly on paper, because most of the OPEC members are within Middle East. And we have seen a constant decline in production as well as exports coming in from many of these countries. And then it's not just about the crude prices. You have heating oil, gasoline, all of that trading at 2022 highs as well. A report from IEA suggests that the damage is quite strong. And when you look at the regional shut-ins, that stands at 12 million barrels per day. And there is a damage to about 40 energy facilities, all of that finding its way in sense of prices there. This is the data that has come in from Clipler and Jody, which says that the March revenue for many of these Middle East countries actually has seen a decline, barring, of course, Iran, which saw 37% increase on an year-on-year basis for the month of March. We also have seen an increase coming in from Oman and Saudi Arabia, but a very sharp decline from Iraq and Kuwait when it comes to export revenue in sense of crude oil, and UAE is down 2.5% as well. It's not just about the crude oil prices. That impact seems to be coming in for other commodities as well. So when you look at cotton prices, there is, of course, production cuts in Brazil, China, Australia, the major producers. But the prices have jumped up to 2024 highs also because the higher crude oil prices have led to an increased cost of synthetic polyester there. There is very strong gain in this one commodity, and you should watch out for that. And that is tungsten. This commodity has gained up by 557% in the matter of last 1 year. Now, the market value for this is $16 billion as of now, and the military use is expected to increase by 12%, is the report coming in from Project Blue. Well, tungsten is a metal which China produces the most, and China has put it in export control list in the month of Feb last year. Now, China produces nearly 80% of all tungsten that is available in the world markets there. When you look at the uses of tungsten, and that is exactly where the markets are finding its support from. It is used in drilling equipment, semiconductors, armor-piercing weaponry, also in helicopters, in fighter jets, and most importantly, in ammunition. And is the reason that you have seen a very strong price increase for this one, 550% up in last 1 year itself. And when you talk about the 2026 till time, well, this is a report card that we're working with right now. So you have US crude, which is up 100% now in this year. You have Brent, which is gained up by 84%. Urals is the Russian crude, which is up by 140% in this year. 95% of gains is what we are working with in sense of gasoline as well. And then take a look at sulfur. So everything that has to do with fertilizers also has been surging. 84% of gains in sulfur, 54% up for synthetic rubber, and polypropylene is up by 47% as well. So crude and crude varieties, and directly, indirectly, is impacting all of these sectors.
Thank you very much for that. Let's get back to the market. Still down about 0.5% on the benchmark indices, but the Nifty's managed to recover 150 points from the day's low of 22,719. Vinay Rajani of HDFC Securities is now joining in for a technical check on the market. Vinay, what's the call for the morning?
Yeah, good morning. So few reasons are there. Because of that, we feel that Nifty has bottomed out for the short term. First of all, Nifty has taken out the 10 days EMA resistance after a long time since the war started. The other reasons have been that the RSI, the oscillators that we have been tracking, that is showing the double positive divergence. And the most important development is that the Nifty has been able to cross the previous week's high. So last week the high was 22941 and this week's high is 22998. So it has decisively crossed that high and it's trying to sustain about that. So there are the few reasons which are giving us an impression that Nifty should sustain this time and there should be a meaningful recovery in the market. And the next resistance for the Nifty that we see is around 23,465 or where the previous swing high is placed. So the stop loss would remain around 22,550, which is this recent swing low, yesterday's low. So that should be kept as a stop loss 22,550. On the upside, we are expecting 23,450 to 23,550. These are the developments on the charts and which are showing us that the market should continue this meaningful pullback rally.
Vinay, hi. Good morning. What would your specific trades be?
Yeah, so IT stocks have been performing good before the earnings. So HCL Tech is one of the stock which has shown some good breakout from the consolidation. So HCL Tech around 14231 can go long. 1400 should be the trading stop loss on the upside. I'm expecting a target of 1475. The second stock I would pick from the PSU space, the Coal India. Coal India is looking extremely strong. It has been very resilient in the downfall of the market. So Coal India around 458 one can go long. 450 should be the trading stop loss on the upside. I'm expecting a target of 475.
All right, take that point. Thanks a lot for that. Meanwhile, Trent has recovered from the lows, opened lower, and currently has now moved into the green, a gain of almost 0.75%. Poonawalla FinCorp is the other notable gainer in the broader markets, up around 4% as we speak, and delivery continues to do well. So far, this in the last few days, the stock has rallied a goodish bit, positive for the month as against the market, which is lower. Take a short break, come back on the other side. Gautam Duggar of Motilal Oswal joins in to talk about the impact of West Asia war on the Indian market, expectations from the fourth quarter numbers and earnings trajectory.
Welcome back. There's market recovering once again. So back above 22,900. Advanced decline is looking better. Nifty Bank is pulled back as well, down about 400, just about 400 points now. Well, Motilal Oswal puts out an exhaustive set of expectations as we enter any earnings season, and they've got one of the largest universe of stocks under coverage. Gautam Duggar is head of research institutional equities at Motilal Oswal Financial Services. Gautam, good morning. Good to have you with us here. Thanks for joining in. So actually, two questions. How have you changed as you were building penciling these expectations in? How has the conflict affected those projections? That is one. And second is, some of this impact of what we are seeing now is going to come in the future, not in these results, at least not fully. So how does one account for that? Gautam, go on.
Hi, Prashant. Good morning. Thanks for having me here. Look, I mean, this is an evolving situation. So whatever numbers we discuss, in a quarter's time or a month's time, those numbers can change on either side. So as we speak, our team, when they did the estimates for this quarter as well as next quarter, there's definitely an impact which is coming in. This quarter's numbers, we are expecting a growth of about 10% for our coverage universe and 6% for Nifty. This numbers, when the third quarter ended, our expectations for the fourth quarter earnings growth was 14%. More importantly, the numbers have been cut pretty sharply for FY26 as well. While at the aggregate, it doesn't reflect because there are counterbalancing forces, specifically in bigger benchmarks like Nifty. So if you look at the Nifty picture, we've cut estimates by about 2% for FY26. Please understand this 2% is coming in for just one quarter's numbers because 9-month numbers were already delivered, right? And next 2 years numbers have been cut by about 1.5% each. Nifty gives a very misleading picture actually in such situation because in Nifty, only 30% of the profit pool gets directly impacted by higher commodity prices, right? You have consumer auto consumer durables, cement, and to an extent pharma. Otherwise, metals, oil and gas actually benefits. And then you have banks, utilities, telecom, which doesn't get directly impacted in the immediate term. So the right way to look at numbers changes is to look at broader markets. When I look at our coverage universe of close to 366 stocks, and then I see the spread of the earnings, we've seen a cut of about 6% for FY27 for both mid caps as well as small caps, right? The large cap earnings cut is limited to about 1.5%. So that aggregates to closer to 3% earnings cut for FY27 for our broader coverage universe. 136 companies in our coverage universe have seen earnings cut of more than 3%. And there are only 25 companies which have seen an upgrade of more than 3%. So that tells you which way the dice is tilting. And even now, I think the expectations are still slightly elevated because analysts are still baking in the impact for the first quarter or first half. And if this situation lasts for another 30-40 days, you will see next round of earnings cut going through as the earnings season begins and corporate starts providing commentary for April and May. Because there are a lot of second, third order impacts which we are still not clear.
You said mid-cap and small-cap earnings for FY27 have been brought down by 6-7%?
Yes.
Okay. Do you want to tell us which particular sectors have seen the biggest cut so far? And what is the potential downside risk from here on? You said the risk is that if there is a continuation in the conflict beyond, say, the month of April, it goes on till May and June, and then the second order, third order effects also come in. So elaborate a little bit more on the potential downside, the worst case scenario.
Rima, worst case is difficult to picture in. Even the best case is difficult to picture in. So we will see as things evolve. It's very futile to predict things when things are so volatile and fluid on a daily basis. As things stand, there are 3 or 4 sectors which have seen the maximum cuts. One is auto, where we have seen for our coverage universe of 27 companies, around 5% earnings cut for FY26 and around 11% for FY27. So there are many companies which have seen 15 to 20% earnings cut for FY27 because of twin impact of higher commodity prices and some impact on global demand too. And there's cement, which has seen double-digit earnings cut for FY27, close to 12%. We've seen 4 to 5% cut in many sectors like capital goods. We have seen EMS, we have seen close to 6-7% earnings cut. Even utilities has seen a pretty substantial knockdown. The only sectors which has basically bucked this is metals, which has actually seen an earnings upgrade for FY26 and FY27 both. And oil and gas has seen upgrade for FY26, while 27 has seen a massive cut because of OMCs and CGDs, even as ONGC and Reliance has provided some solace to FY27 earnings. But net, even oil and gas has seen a double-digit knock. So these 3-4 sectors have actually resulted in a disproportionate impact. On the contrary, IT has seen a 2-2.5% upgrade for FY27 because of currency impact, even as we've seen some cuts in FY26. So net, if you blend all of that, you're talking about a 3% earnings downgrade at a broader coverage level for our 360 plus stocks, within which mid cap is 6% and small cap is also 6% earnings cut for FY27. And as I said, at the cost of repetition, these numbers can change on either side depending on how the next 20-30 days pan out on global geopolitics and the energy situation.
Take that point entirely, Gautam, and there's a thorough analysis out here. Just thought on the Nifty valuations, where we keep talking about them being in line with average or during periods of weakness that we've seen. I'm just looking at your estimates, nearly 1,250 rupees next year as EPS. That gives you at current levels a Nifty of around 18.3 times. How does that compare with average? And while we do that, also be mindful of the fact that when we compare it to, say, COVID levels or earlier crisis, we didn't have a lot of these high PE stocks in the Nifty. Since then you have, say, something like an Eternal in the Nifty, you have something like a Trent in the Nifty. So those skew the overall valuations as well. If you take that off, how does that compare then?
Definitely, Mangalam, Nifty is looking far more reasonable, and it's at almost a 15% discount to long period average. The long period average is somewhere close to 20.5 times for Nifty. We are right now at about 18 times. If you go back in September 24 at the peak, Nifty was almost trading at 24 times. Even a year back in March 25, Nifty was trading at 22 times. So from 25 to 22 to now about 18 times, Nifty is looking a lot more lighter, even if you account for the uncertainty which is prevailing currently. Even mid caps and small caps, given the time and price correction that we have seen, some of the stocks have obviously seen a much bigger damage. But just look at the index level. If we take Nifty mid cap 100 and small cap 100 as representative of these two market caps, so mid cap is down from a P of 35 to now about 25. It's still at a premium to long period average, by the way. And small cap index, which had a P of 24 times in September 24 peak, is now down to close to 20 times, which again is at a premium to long period average. So clearly valuations have lightened up. Nifty is looking far more lighter and far more reasonable today, given the context of 10-12% earnings growth that we are envisaging for large cap. But mid cap and small cap may undergo some more time correction or a mix of time and price correction, depending on which stock you talk about, because it is futile to talk about indices in mid and small cap. It's always more bottom-up, sector-specific for valuations.
Gautam, thank you very much for joining in. We're out of time, but it's always a pleasure to get your analysis on numbers. We'll look forward to chatting with you as the earnings season progresses. By the way, the markets have recovered and now the Nifty is back above 22,900. The cut is modest, just down 0.3%. Get into a break. On the other side is our special segment. It's the economy. Lata will speak to Suyash Chaudhary of Bandhan AMC and Abhishek Upadhyay of ICICI Security Primary Dealership on the bond markets.